In today's podcast, I'm going to share with you 5 ways I'm going to ensure my property investments outperform this property cycle, and not just in 2025, but moving ahead. So welcome to another episode of the Michael Yardney podcast, where we help investors gain clarity amongst the confusion of the many mixed messages regarding the property market so that they can develop the financial freedom they're looking for. Now, if you're a regular listener to this podcast, or watcher of, is watcher the right word, viewer of these on YouTube, you know I usually have a guest, but every now and then there's a topic that I want to just share with you, just you and me, to make sure I get my message across properly. And this is one of those episodes where it's just going to be you and me. As I said, I'm going to share with you some fundamentals that I'm going to use to ensure my property investments outperform, and I want you to as well. I mean, we're at the beginning of a new year and there are so many mixed messages already. So what I want to do is remind you of some of the foundational principles I have used over 5 decades to grow my wealth and to help clients at Metropole safely outperform the markets. So let's get on with the show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Well, as we're into a new year now, many of us are going to be focusing on the times we experienced over the last few years and try and extract some lessons we've learned. But rather than do that today, I'd like to remind you of some of the foundational principles I use to grow my wealth. Let's look at the things that have always worked rather than things that are working now. Now, to be clear, this is very different from what most of you go to hear in the news, which basically focuses on short-term investment trends. You know, those headlines that we've been seeing so much of recently, the top 10 areas to invest in 2025, top 5 lessons from 2024, what's ahead for interest rates, or where's the next hotspot. Now, remember, all these are short-term forecasts for property, but just look at what happened to all those forecasts, maybe even just a year ago, and then the about face all those economists had to make over the last year when their predictions were so wrong. And it was much the same as the forecast made, back in 2020 when COVID hit, or those forecasts made at the beginning of 2019 when the spectre of a Labor election Labour was going to win the election and change property taxes. Remember, all those forecasts were wrong. And what about all those cliffs we were going to fall off? Remember, there was an unemployment cliff where unemployment was going to get to double-digit growth, where there was going to be an interest rate cliff, and then more recently the fixed interest rate cliff that didn't eventuate, that predicted there was going to be so many mortgagee sales. What came of all those forecasts? But of course, it's not just property forecasts. Just look at the financial section of the newspaper or the websites, and you're going to read about the resurgence of Bitcoin, which is almost an all-time high, or the Australian stock market, which performed well despite all the economic challenges we're facing. But only a few months ago, gold was in favour. And who couldn't forget the surge in the value of technology stocks at the height of the COVID lockdown, and then what happened to them? Now, these type of headlines lead to a short-term focus and encourage investors, or let's be blunt, call them speculators, to try and time the market or look for the next big trend. But having been around the block a few times now and invested for over 5 decades, I've realized that successful investing, like many things in life, is counterintuitive and actually countercultural. One of the core tenets of my approach to investment success is goal-focused and planning driven. And the good news is, by focusing on the long term, by focusing on big picture trends, it removes the burden of correctly guessing the future short term trends such as interest rates, inflation, hotspots, or the many other variables that the average analyst and many investors spend their days obsessing over. In a culture that tends to be market-focused and performance-driven, my approach sees our clients at Metropole, and also my personal investing, acting on a financial plan, a customized strategic plan that we build for our clients, rather than reacting on the vagaries of the investment market. So even before we talk about location or properties or residential or commercial or development or where or cash flow, we always start by putting a strategic plan together for our clients at Metropole, because what works for me at my stage of investment and what would be appropriate for you would not be the same. In fact, what would be appropriate for many investors today is very different from what would have happened, what would have been the right investment many years ago. So therefore, the plan's got to suit their long-term goals, but also where they are at the moment. But being long-term focused with these plans means we invest in the type of property assets that have always worked, rather than what's working now or what's going to be hot this year. At Metropole, our approach is to build a number of frameworks that have stood the test of time and are proven and trusted, well as following a number of sound principles. So let me just share with you a number of principles that I use in my investing and I recommend you consider as well. The first one is have faith in the future. While it's easier and more trendy to be pessimistic, I believe that optimism is the only realism. There are so many doomsayers out there, and I know that because I regularly get trolled by many of them, particularly on YouTube. There's never been so much information out there about how to become financially fluent today. However, there's so much financial misinformation, and I guess this has made many people pessimistic. Oh, by the way, I don't know a rich pessimist, yet based on history, I can confidently believe in the ability of our capitalist society to prosper on the back of our collective ingenuity. In the last few years, if they hadn't taught you anything, they should have taught you that residential real estate in Australia is an asset class too big to fail. Neither the government or any political party, well, actually there is one political party of a green persuasion, but neither the government or the Reserve Bank or the private banks are going to allow it to fail. More than that, residential real estate's a great asset class for normal Australians to use to build their wealth, because it's underpinned by that large population of owner-occupiers. Remember, 70% of properties are owned by owner-occupiers, homeowners who would rather eat Maggi noodles than give up their home. And remember, around 50% of these homeowners don't even have a mortgage against their home because they paid it off a long time ago, having bought their properties a long time ago. And there's also a large percentage of homeowners who at least paid off a significant portion of their mortgages. So lesson one is have faith in the future. The second fundamental I want you to remember as we go into this new year of property investment is to have patience. Contrary to the financially illiterate, strategic investors refuse to react inappropriately to disappointing events. That's why we put a plan together. It teaches them what to do, but also what not to do. Oh, by the way, if you'd like to understand how a strategic property plan would help you, why not go to metropole.com.au and find out how our team can help you. We're much, much more than just buyer's agents. We help our clients safely grow into generational wealth through strategic property and wealth advice. And that's why they have a plan to follow, and they act on the plan rather than on the short-term ups and downs of the investment markets. They recognise that wealth is the transfer of money from the impatient to the patient. The third fundamental we base our investment principles on is discipline. Similar to the principle of patience, discipline sees strategic investors continue to do the right thing, even if the fruits of their decision can't be seen in the short term. Like at the moment, many clients are investing in Melbourne, and I am sure that there'll be other markets that are going to outperform Melbourne over the next 6 to 9 months. But Melbourne property is so underpriced now compared to other states. There's so much built-in equity in it that people with a long-term strategic focus, people who have optimism in the future, are taking advantage of the window of opportunity in the Melbourne market, even though, as I said a moment ago, the fruits of their decisions may not be seen for a while, but they've got discipline. The fourth fundamental I want to share with you today is build a great team around you, because property investment is a process, not an event. In fact, property investment is a long-term process, and it takes around 30 years to develop financial independence through residential real estate. Now, I know there are some people out there that can tell you can do it before this next Christmas, or you can buy 10 properties in 10 minutes. I've been around the block long enough to see what happens to these over the long term. Sure, having bought in many locations over the last couple of years where there's been double-digit growth, people have seen spectacular short-term gains. The question is what's going to happen in the long term. All the successful investors I've known continue to educate themselves so they become financially literate. And they're very careful whose advice they take because they've learned most educators or so-called advisors have a vested interest. Oh, by the way, if you want to get into a room with a very group of already very successful investors, why not join us at Wealth Retreat on the Gold Coast from the 3rd to the 7th of May? Go to wealthretreat.com.au and find out about it. Hey, don't count yourself out. This is not just the opportunity of getting good advisors. It's the opportunity of being part of a community of already successful investors who behind closed doors are prepared to share their wins, their losses, their lessons, their experiences. I'd love you to join me at Wealth Retreat so you can make the best next 5 years, the best 5 years of your life, because the theme of Wealth Retreat is where you're going to be in 5 years' time, in 2030. See, one of the great lessons you should learn from other successful investors is they surround themselves with professionals and mentors, and they're prepared to pay for advice to ensure they maximize their investment returns. Yet while successful investors pay for their mentors, the average investor gets their advice for free over the internet or in blogs or on YouTube. They haven't learned the simple fact that the cheapest advice is the one that gives you the best investment results, not the one that's free. And obviously, you're not going to get the best investment results with free advice. On the other hand, financially literate investors accept the guidance of their holistic wealth advisors. And if they have sufficient discipline and allow time for compounding and leverage to work its magic, their investment success is, well, I was going to say guaranteed, but very likely to occur. Look, while it's simple, it's not easy. So here's the fifth way I'm going to ensure my property investments are successful, not just this year, but moving forward. And that's the fact that I don't make forecasts. On the other hand, I have expectations. As you can imagine, I'm currently being asked, hey, what's ahead for property in this new year? I'm asked that by clients of Metropole and by so many media outlets now that we're at the beginning of a new year. And I think I'm disappointing them with my answers because I tend to say something like, a lot's going to happen over the next decade, but I don't make forecasts. Instead, I have expectations. Now, there's a big difference between forecasts and expectations. I expect there's going to be another recession in the next decade, but I don't know when that's going to come. I expect the property market's going to boom again over the next few years, and then prices are going to slump again, but I don't know when. I expect some investments I make won't do as well as others, but I don't know which ones they're going to be. I expect interest rates are going to fall this year, but I don't really know when. And I expect there's going to be another world financial crisis, but I've got no idea when that's going to come. Now, these are not contradictions or a form of cop-out. As I said, there's a big difference between an expectation and a forecast. An expectation is an anticipation of how things are going to play out in the future based on my perspective of how things have worked in the past. A forecast putting a time frame on that expectation. Of course, in an ideal world, we'd be able to forecast what's ahead for our property markets with a level of accuracy. But we can't because there are just too many moving parts. Just remember the beginning of this chat I had with you when I explained all those forecasts that went wrong. Sure, there's all those statistics that are easy to quantify, but what's hard is to identify exactly how millions of strangers are going to act in response to the prevailing economic and political environment. And then every year, there are these X factors that crop up. I've discussed those before in my podcast, those unforeseen events that come out of the blue. They could be local, they could be overseas, and they undo all the forecasts we made. So what should you do about this? Well, I found the most practical approach is to have expectations of what could happen without specific forecasts. That's because when you expect something to happen at some stage in the future, you're not surprised when it happens. Expecting the worst while preparing for the best forces you to invest with a room for error and psychologically prepares you for the inevitable disappointments. That's exactly how I planned for the property downturn of 2018-19 and why I was prepared for the challenges of 2022 when interest rates started rising and property values slumped for a while. Now, I didn't know when the property downturns would come or how long they'd last or how they'd affect the value of my property portfolio or the cash flow of my business, but I knew a downturn would come again, and I was prepared for it with cash flow buffers to see me through difficult times. By the way, that's part of what we do when we put a strategic property plan together for our clients at Metropole. We don't only help them buy properties, we help them buy time by having a finance strategy that gives them buffers to see through the challenging times. Once again, let me suggest you have a chat with the wealth strategist specialists at Metropole have a wealth discovery chat. Just go to metropole.com.au and learn about how a strategic plan can help you plan to become the person you plan to become. So I guess what I'm suggesting is that even though I didn't know when these downturns were going to occur, it helped me, it prepared me for the difficult times. And I wasn't surprised. What I'm trying to explain is there's a huge difference between I expect another property downturn sometime in the next decade, or I expect that property downturn to be in the second half of 2027. And it makes a big difference in how I invest. If I expect a property upturn or downturn is going to be followed by the next phase of the cycle, I won't be surprised when it comes. And since I don't know when it'll happen, I won't focus my property investing trying to time the cycle. That's because trying to time the cycle or looking for the next property hotspot are two of the reasons so many property investors fail. On the other hand, strategic investors maximize their profits during property booms and minimize their downside during downturns by investing in assets that have always worked rather than finding the next hotspot or the type of property strategy that works now. Investment grade assets in investment grade inner and middle ring suburbs of our big capital cities. The type of property that's going to keep growing in value over time without fluctuating widely in price when property cycles change. And they also know there's always going to be another X factor. As I said, those unexpected risks that you don't see coming. And strategic investors try and protect themselves by owning the best assets they can, by having financial buffers like I've explained to ride through the ups and downs, setting up the right ownership structures, insuring themselves, because really they're going to need their personal exertion income until they've got a big enough asset base, and by obtaining holistic advice from their consultants. But as I explained, the biggest risk is the risk that when no one sees it coming, because if no one sees it coming, if no one's prepared for it, the damage is amplified when it arrives. And an X factor, an unexpected event, seems to come every year, and a major one that breaks the world, seems to come every decade. So what does this mean for you as a property investor? Well, as I said, I'm not going to make any predictions for the future of property in 2025. However, I have some expectations that this year is going to be a year of two halves. I see the market moving into the next phase of the property cycle when interest rates eventually start to fall sometime later this year. Now, in general, when interest rates decline, the market tends to experience a surge of activity. More buyers can afford larger loans, and as demand escalates, property values start to go up again. And then buyers who have previously priced out of the market start to re-enter it. And those who have been sitting on the sidelines, they rush to buy before prices climb too high. And this creates a snowball effect that can rapidly drive up property values in certain markets, in growth markets. However, here's the key takeaway. Waiting for rates to drop might mean missing out. Throughout last year, despite relatively high interest rates, in some areas, property prices grew at double-digit rates. There are always markets within markets, and while some areas may cool down in the first half of this year, others are still going to experience strong growth. And this highlights the importance of looking at data-driven insights and taking off the risks of short-term forecasting. You see, I see the current market offering a window of opportunity for property investors with a long-term focus. We have what I guess some would call a perfect storm of factors that are going to lead to strong property markets over the next couple of years. We've got continuous strong population growth, despite the government saying they're going to lower population growth. We've got a shortage of skilled labourers. We've got a massive shortage of housing. We've got inflation that's coming under control and is soon going to be within the Reserve Bank's target range. We've got interest rates that are set to fall. And when rates do start to fall and buyer and seller confidence returns, the property cycle is going to move to the next stage. So as I said, I see this as a window of opportunity for those who are financially in the position to buy their next home or investment property. Now, I'm not suggesting you try and time the market. As I said, that's too difficult. In truth, you've missed the bottom. That occurred 2 years ago in early 2023. But if the market hands you an opportunity like this, a quiet patch before the next phase of the cycle, why not take advantage of it? Taking advantage of the upturn stage of the cycle has created significant wealth for other investors in the path. And moving forward, demand's going to continue to outstrip supply for some time to come. As I said, we're experiencing strong levels of immigration and we're just not building anywhere enough properties. At the same time, the cost of construction, the cost of delivering new dwellings is going to keep increasing. Yeah, it's not rising as much as it used to, but it's still going up, not just because of supply chain issues, but because of the lack of sufficient skilled labour. And also, builders and developers are being very cautious commencing new projects. They want to make sure they're financially viable, and we're just not building enough the medium and high-rise towers because they're too expensive. I've discussed that so often on previous podcasts. And as I said, I believe consumer sentiment will rebound when it becomes clear that interest rates are falling and all that pent-up demand is going to be released and greed, FOMO, is going to overtake fear. We're also going to experience a prolonged period of rental growth. The rental crisis is only going to worsen. We've discussed this often in previous podcasts. There's no end in sight to that. Now, I'm not saying take advantage of tenants. What I'm suggesting is to recognise that there's currently a problem, a lack of rental accommodation, and I'm suggesting become a provider of a solution for that. So rather than trying to hunt down a bargain, my suggestion to you is to focus on buying an investment-grade property in an A-grade location, because these type of properties are currently in short supply. They're not going to be a bargain, but they're going to hold their value better in the long term. Now, while it might feel counterintuitive to buy at a time when there's so many mixed messages in the media, I believe you can benefit at this time when there's less competition, lower consumer sentiment, minimal downside risk, and virtually no risk of oversupply. So there we go. These are the ways I see that I'm going to outperform, ensure my property investments are going to outperform in this stage of the property cycle, and I'm recommending you consider doing the same. Similarly, I'm going to recommend you have a chat with the wealth strategists at Metropole, because as I said, we're much more than just another buyer's agent. We're going to help you safely outperform the markets by first of all, putting a strategic plan together using very, very powerful software. And by the way, you have access to this software so you can do all the what ifs as well, if that's what interests you. And then we're going to help you implement the plan using our wealth advisor, our property management, our buyer's agency services, property development, project management services. We have a range of services. I don't know what's going to suit you. So that's why we don't have any properties to sale, but I'd love to have you as part of the Metropole community and allow us to help you safely outperform the markets. Go to metropole.com.au and let's make 2025 a great year for you in property.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to share with you a concept that I learned from Carl Richards called the behaviour gap. Now, Carl Richards used to write for the New York Times, and we were allowed to republish his blogs on Property Update, and you'll find a few of them there. And he called his blog in the old days the behaviour gap. Look, there's a little exercise I'd like you to try and do so you understand what I'm getting at. Look, I know you're probably riding, walking, exercising at the moment while you're listening to this podcast or watching it on YouTube. So when you have a chance, I'd like you to take out a piece of paper and on the left-hand part of the paper, draw a box and label it what I say I want to do, what's important to me, or how I want to spend my time. And on the right side of the paper, Carl Richards said, draw a box labeled how I actually spend my time. Label the space in the middle between those two boxes the behaviour gap. You see, over the years, I've noticed how big this gap is for many of the people I come across. It's interesting to see what people say they want to do, even an hour before they take action, and what they actually do end up doing. Ask people how they want to spend their day, and at the end of the day, ask them how they spent their day. In general, you'll find what they ended up doing wasn't nearly as valuable as they'd hoped it would be. Have you ever spent an hour or two and then thought, boy, that was a waste of time? It's interesting to look at the difference between what we say we want and what we know we want to do and what we actually do. I guess that's human nature. And the first way to close this behaviour gap is actually to recognise it. And that's why I'm mentioning it to you today. So starting today, your increased awareness of your behaviour and your behaviour gap will slowly lead to behavioural change. At the end of the day, you're going to say to yourself, hey, look at the difference between what I said I was going to do, what was important to me, and what I did. Isn't that interesting? Just simply start noticing the difference, and slowly you're going to change your behaviour. Short and sharp mindset message today, but Hopefully it will help you close your behaviour gap. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. Oh, and I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?